investment management for European credit products. My previous experience has been with Dresdner and Nomura and Toronto Dominion. Apart from that, I'm just looking forward to having an interesting discussion on the implications of risk, since I was very involved during the period of 07 and 08 in consulting and actively managing a lot of distressed portfolios. So that's where a lot of my focus has been in the last 5 or 6 years.
Good morning. My name is Samir. I work for Cheney Capital. I'm in the risk team. Cheney, I'm sure some of you are aware, is a multi-strat hedge fund. We have a significantly big fund that focuses on ABS, corporate credit. In addition to that, we've got a convertible bond, merger arbitrage, and an equity strategy. Prior to Cheney, I worked at UniCredit. Before that, I was unfortunately at Fitch during the whole CDO blow-up, and I was before that in Morgan Stanley. I've been at Cheney for 4 years, and primarily our main focus within risk is doing fundamental analysis at the issuer level. And all our overlay strategies for risk management flow from that. So we'll hopefully discuss a little bit of how we go about it.
Okay, thanks guys. So I've got a few topics here, but really, as I said, it's a bit of an open agenda, but some just to lead off with a few talking points. Given so much is going on across the market and has been in the last few years, the role of risk management, as I see it, is fundamentally changed in that its profile has moved to more of a senior management, even C-suite exposure. Probably in the past that didn't get as much exposure as it really needed. So the first topic I wanted to touch on was really risk management and governance, and how that has changed given the impact of regulation. We've seen certain market events, so what role would the organisation expect to see in those, such as the Swiss Euro movements, last year's movements in US Treasury market. So how is risk fundamentally changed to actually play a role in that type of activity? And the reason I say that is because if you go back a few years, risk, and certainly as we go through the credit crisis, the risk was accused of being a little bit on the back foot in reporting history instead of keeping up with what was happening, and certainly horizon scanning. So open it up to the panel, and would love to hear your views as well.
I think I'll just share my initial thoughts from a market-based perspective. I think, ironically, I think we are seeing, from my perspective, a more segregated impact of regulation on the sell side and the buy side, especially in the aftermath of 07 and 08. I think the sell side in the credit sector have been more rigorously assessed and picked over. And in fact, as an initial observation, because I do think this is a very pertinent topic, a lot of the liquidity measures that the central banks are trying to flow onto the market, in a way, are kind of also being stemmed by not necessarily onerous regulation, but rather much more tighter regulation on the sell side, market makers, who are now forced to act more as brokers rather than necessarily as proprietors of risk. So there's a shift now, especially after 07 and 08 and the credit crunch and the consequences of that, that now they are trying to sort of stem the sell side from actually taking on excessive amounts of risk. And that does have an impact on the market, because valuations were being supported previously a lot by the market makers themselves, and now I think that's just one of the optical consequences of a more rigorous regulatory environment.
Yeah, so taking from Zachary's point, I think on the buy side there's a clear, we're not being impacted by the onerous regulation so much from what's happening on the sell side. But what we spent the last 12, 18 months being impacted on the investment management side is AIFMD. So I'm sure, and I know there's a panel later on and they'll go in more detail on that. So, which basically is entailed that there's a lot more focus on buy-side firms, especially risk management, which already should have been, but it's just significantly more enhanced, and it's now going to be more regulated, so we're having to build up systems and apply all our funds, which are not usage funds, as AIFs. So there's a lot of system requirement or needed there, and has to be built up. And it's especially onerous for smaller funds, which do not have the bandwidth to spend all that money on systems. In terms of impacting indirectly from what's been happening on the sell side, for instance, on our trades on the strategies where we have correlation strategies, we're finding that the sell side providers are diminishing. So the people who we could make those trades with 5 years ago is now, you could count it on probably one hand, not even two. So it's having an impact on how we can execute our strategies, and that's leading us to evolve how we present that product and how we evolve it. So regulation is clearly impacting us in a different way, but it is definitely.
Yes, I think one of the more obvious, I mean, just to take on Samir's point, is that the liquidity environment has, from a buy-side perspective, has, and even for more vanilla products, rather than necessarily the more esoteric trades, has actually diminished quite significantly. Before, you would have 6 or 7 providers with whom you could actually have depth to the market. So in a way, I mean, my own personal worry is that, do we have enough support in the bond market? And at the end of the day, there has been this whole tagline. I mean, I'm speaking more from a credit perspective rather than, say, from an equity perspective, but I've heard some risk managers and some traders say that the trend is now to make debt more like equity. But then, at the end of the day, I mean, equity is a standardized product. Debt can never be that. I mean, there are different maturities. There's a new issue cycle. Ironically, the new issue market is expanding very dramatically, in contrast to the secondary market, which is tightening. So you see a lot of divergences, and I think there is a lot more clarity that needs to be given to the secondary corporate market. Otherwise, we could see, a lot of, as I said earlier, a lot of the central bank provisioning not flowing effectively enough because they're being constricted at the FCA PRA level. And that's what, in my conversations with a lot of my counterparts, this is just what they're telling me, that Zach, we can't take on this risk, we'll broker the risk for you. But then when you're asking institutions like, I mean, the big players like whoever, Goldman's or JP or whoever, whatever, to actually start being brokers for you, I mean, there are another 11, 12 distressed credit brokers in the market. So what are they actually ultimately offering over and above if they can't take on that risk onto their own books? I mean, that's just something that, for me, is a question that I think will have some ramifications for this market in a couple of years.
So where I see particularly with regulation, where I see the impact is that, yeah, there is a particular focus of regulation on various sectors of financial services, whether it be insurance, AIFMD, banks, but really, overall the impact is, it's like, the sea slopping into the boat. Everyone seems to be impacted by everyone else's regulation. So although you can see that there's a certain sector has a certain type of regulation, what's happening in the banking industry and how they actually measure their profitability impacts their relationship with their clients and how they do wholesale funding, how they offer those lines, etc. So when I look at risk management and moving away from your classic credit and market risk and maybe into operational risk, because I'm not quite sure where this all fits. Maybe it sits with strategy, risk management. I'm not quite sure how it all comes together. But this regulation and the impact, particularly given its protracted rollout, horizon scanning and the impact and the unknown unknowns that it could lead to could have a significant impact in something that you think is quite foreign to your sector, but eventually could bring you very close due to tangential relationships. So, and liquidity is a perfect example, and the impact on collateral. So everyone needs collateral, but the way that it's moving under regulation, particularly across the banking industry, once governments get back to a more balanced budget, or even before then, collateral scarcity is certainly something that is on the horizon and should be looked at, whether it's in risk management, it's in strategy, it's in finance, finance directors, something that they should be looking at in their 5-year plans. Liquidity and collateral has always been readily available in the past. I'm not sure how much that's going to be the case going forward. And then you consider that the central banks will then, as they're already doing, maybe increase the risk profile that you can take in and allocate as far as collateral is concerned, which then increases the risk profile of the organisation. So I think this horizon scanning, given the impact of regulation, is pretty important, but I'm not sure where it's resting at the moment across organisations. Because it does fall under the banner of risk, but is it operational risk? Is it really outside of risk scope? And it's more inside strategy? Anyway, just wondering if other people had some comments with regard to that.
I guess I have two questions based on the two observations that you've made, TLG and Cheney. Is the pricing quality of the assets that you're managing is getting worse or better? I stand as an investor into hedge funds and alternative vehicles. And two, I haven't seen many managers that openly will tell you that their portfolio is becoming illiquid. They tend to oversell the liquidity of the fund. Any advice or recommendation that you can make for outside parties review the hedge funds managers in terms of liquidity of the asset types that you're trading?
Ironically, at Cheney, especially on the ABS side, liquidity I think has definitely improved over the last 4 or 5 years since the crisis. Obviously, there's a lot more interest in these bonds, and they've been priced properly. And what we saw last year and the year before, as there's broader sell-off in the market, progressively ABS these sub-asset classes that we invest don't really move that much. They move in a sense, they're considered more illiquid compared to the broader credit market, but the short-term impact on pricing is much reduced. So we're seeing that there's a lot more liquidity coming through. In terms of your second question on how do we assess it, how does an investor, when it's looking at a hedge fund, assess that they are pricing or they're providing correct liquidity? We have a clear valuation policy in place where we're using market, for instance, to mark our end-of-fund prices, and for positions which are classified as level 3, we have a formal pricing committee where internal people, internal to Cheney, and our administrators and trustees all partake, and the directors as well. So I think one of the ways for an investor to look at when it's looking at hedge funds is to understand if there's a clear valuation policy. And that's another requirement of the AIFMD to have something like that in place. So,
thank you for that. The bid-ask spreads, when we do require or request those items from hedge fund managers, we don't get much responses. Is there a reason behind it? Because there's liquidity and pricing metrics.
I think it depends on the strategy. So for instance, if I take a step and look at the other funds that we have, the structured credit space, where basically our strategy is to buy equity tranches of bespoke synthetic CDOs. Now their bid-ask is a big problem. In a sense, it's a problem of the fact that there aren't many providers on the sell side who will do these deals with us. So there, I think the quality of the pricing can be to what you're saying. That needs to be looked at. But all that depends on the strategies that you're looking at. So for ABS today, I think the bid-ask must be, my feeling is a lot better than it was, as the crisis has evolved.
I guess I should take a stab at this. Let's see. So from TLG's perspective, first of all, we aren't doing, we aren't necessarily doing structured credit. We do in fact syndicate a lot of EM risk. So in that case, when we do that, because we are parlaying African and Asian risk onto the market, then we are the ones who are basically working out the bid-ask. So, but that's a totally separate conversation. From the perspective of our own portfolio, when we are investing, you've got to remember, like, when I'm speaking about the credit market, I mean, there's liquidity, and first of all, we aren't in structured credit. So, you know, for me, I mean, obviously in vanilla credit, you have distinct pricing providers. But I think my point in terms of tightening liquidity is where we were 10 years ago, or where we were even pre-credit crunch, and you just saw a lot more appetite for risk and for transactional risk, and you know, a lot more trading appetite in the market in general. And this is just a systemic observation that you know, a lot of market participants now are very careful about the type of risk. You know, before velocity used to be an issue, that, you know, how long can they keep a position onto their books. And from my conversations and from what I've heard is that velocity has really increased as a concept, that, you know, they need, I mean, if they're keeping a position, they really need to be able to justify that. So that's where I just think, from the perspective of maybe we are being a bit too onerous on the sell side, you know, it's quote unquote the banker's crisis, whereas the buy side, on the other hand, I mean, as Samir said, as I've noticed as well, you know, it's been a pretty much, not, I wouldn't necessarily say light touch regulation, but it's very obvious to see where the focus of regulation have gone. And it's on the traditional purveyors of liquidity into our market. So, and I think Paul made an excellent observation that at the end of the day, we're all interlinked. So even though regulation may not impact, say, us directly, at the same time, when it's impacting our counterparts, and they are, you know, and they're trying to match our trades, which, you know, which never happened, you know, 6 or 7 years ago. Maybe that was a golden era. I don't know. Maybe it'll never come back. I really don't know. But when I see them obviously trying to match trades, and obviously sometimes providing prices that are just, you know, that you just won't hit or you won't lift because it's very clear they don't want you to make those trades, then I do think that I don't necessarily even think it's a hedge fund issue. I think it's more a market issue. Like when I talk to investors or clients, you know, I am quite upfront that this is the market where it is fairly liquid. I could liquidate the entire portfolio, you know, by the end of the day, and I wouldn't even have to think twice. I mean, you know, maybe I'll take a discount of maybe a couple of %, but nothing along the lines of, you know, somehow that there's a loss of liquidity. I'm just, maybe because I'm on a panel and I'm pontificating a bit, I'm just bemoaning that we could be in a more liquid environment, because it is very obvious to me that the whole theme of the central banks have been to increase liquidity, and how else are you going to increase liquidity unless it is going to ultimately be through the credit markets? And I wouldn't say that our credit markets are fully functioning. I don't really want to comment on the structured side. I mean, I am reviewing that, I am viewing that, but I'm not even thinking about structured trades, because I just think to myself, vanilla is anyway, you know, has got value, valuations, and I do think from, I mean, ironically, I'm going to stop, but I mean, ironically from the perspective of, say, my perspective, it is a bit of a selfish perspective, because I do see there are pockets of valuation which the buy side can sort of, you know, exploit, because, you know, when you do have, you know, an exit of the market from the, you know, traditional buyers, there are some pockets of undervaluation, but at the same time, you know, as a panelist, I should bemoan the fact that I do think we could have much healthier credit markets. And I'm not saying that we should be hands-off regulation. I do think some regulation is actually very necessary, obviously, but at the same time, we need to be a bit more intelligent about how we go about doing it, which is my main point.
So, just sort of finishing this first, sorry.
I actually have one or two other questions. I first mentioned myself, I'd like to check it out from UBS. One point about Zakari's sort of statement there. For example, some of those statements that you're making are actually quite hard to sort of demonstrate, meaning, you know, if I were to liquidate my portfolio, you know, I'll take a, let's say, 3% discount, etc. You know, people argue about this for a long time, you know, I mean, whether that discount has to be something significant, how do you demonstrate liquidity? By the way, I even asked the impact of size, for example. In equities, you know, you have these block trading quotations. For example, you have like the very significant block of Apple, IBM or something, you know, you send it to brokers and they actually quote you algorithmically, if I were to liquidate this, you know, I'll quote you this just block price. There is no such thing in fixed income, for example. Okay? And I wish PricingDirect looked into such things, you know, I mean, at least model-based, you know, I mean, there was an estimate so that, fund managers or being banks, etc., can use this. That's one issue I see. Obviously, regulation has big impact, and but this whole valuation or collateral valuation or liquidation of these orderly versus disorderly are becoming very big issues. In relation to that, there's another issue which is stress, or asset quality review, Federal Reserve stress, etc. All of these are requiring sort of demonstrable pricings and repricings, or at what value this is still somewhat fair value, not completely off, but reflects the scenario given. All of these are still in the open as far as I can observe, and risk managing that becomes very difficult.
So, and sort of just touching on some of that, particularly as we look across all stress tests and asset quality reviews. One last point I was going to make on governance is really internal structures within organisations. So you don't have to go back too far to see that a number of the control functions are working in silos. So that might be valuation, product control, finance, client, risk management, operations even. I'm just wondering, since the credit crunch, if there's any comments about how those silos are starting to break down, if at all, because risk is really something that sits above all of that, irrespective of the single risk function. And how are people seeing that within their organisations, those silos breaking down so that information and communication is flowing much more freely? Because there's so much internet and everyone's looking at it from a different point of view.
If I have to provide a sort of a personal history on this, I used to be on the credit side, counterparty credit risk, credit risk analytics. Now I'm in a market risk department because we're joining forces, and the new team is more on collateral, because that's where the move is. As you said, for example, there is significant need for collateral. That's OTC derivatives and even the CCP requirement space. That's one. The other thing is, because the CSA eligible collateral is yielding nothing or sometimes negative, more and more counterparties are asking for bespoke sort of collateral. And there's also the need for leverage for fixed income managers. A lot of our clients are asking for, more exotic fixed income assets to be leveraged. So, you have to consider whether you should take that as collateral and leverage, financing basically. But the interbank financing, I think, is really moving to central banks.
Okay, so just moving on then, the other thing that I want to talk about, which, and just wondering again how it is, how the impact is moving across the market, is systems and infrastructure. So certainly for the bankers in the room, under the bar requirements, this BCBS 239, which is all about risk aggregation, which is a massive project that banks have to undertake and get all their risk data in line, 2016 or 17, to facilitate asset quality review, stress testing, and make sure that risk data is user-friendly and accessible and all those good things. As a general comment, though, I would have thought, since the credit crisis, that systems infrastructure is sort of a key topic for most organisations, given the varied systems and spaghetti junctions that people have built up over the years. How is the certainly from a risk management perspective, how that will actually feed through to be able to pull together the risk oversight on a much more proactive and frequent basis than maybe overnight even. So just interested in comments about systems and changes and the focus that's coming through. Any comments from the panel first?
In terms of, we're not impacted by that specific requirement, but I think systems depends on the organization, because at a smaller place like ours, I think you have to do a lot of work yourself. So for instance, we built our own models for analyzing these positions, and a lot of the IT work it has to be staggered. So for instance, most of the IT effort from our side for the last year has been spent on getting us ready for the AIFMD filing, which was fairly recent. So what that entails is the individual departments have to do a lot more system building ourselves. But we have some IT resources. But
so you're not seeing a significant increase in systems investment?
we are. We have, for instance, internally over the last 5 years, rolled out a new front-end system which is firm-wide, because prior to that we used to, individual desks or trading teams were using their own systems, were Excel-based or some other systems. So there's been a massive effort to streamline everything and provide data in a consistent format that everybody across the firm can see. But it's all about priorities at a firm like ours, where our IT teams and the resources are limited, so there's strain on what we can do. So and a lot of the other side of our system requirements is driven by what investors want to see. So there's been focus on risk matrix, there's been focus on Opera. So as a couple of systems I mentioned that investors tend to look at. So as the clients, the investors get more institutionalized, so there's a lot more focus on that side as well from systems. So it's a bit different from a bank, the way system requirements is.
It's quite interesting because it also ties in with what this gentleman was asking specifically to TLG. I think just a couple of points that I wanted to make on systems is that we've actually, I think Samir's actually raised a very good point on the buy side, that we've basically been spending a lot of time in the last, I think, 3 quarters, especially when the credit markets were, a bit more fraught, so to speak. We've basically built a very strong in-house system. We've hired, some developers and so on to actually rebuild our risk matrix. And when I was giving those figures, like as an example, one of the main things that we did was we marked to bid, and then we sort of take a liquidity premium, a liquidity discount on our portfolio, because we promised, we're now moving towards a trend where we're shifting from a 90-day liquidity window towards a 30-day liquidity window, that we're promising that any investor who is invested with TLG, especially in the fixed income side, can basically liquidate their holdings within 30 days. And so we're trying to make it a much more liquid portfolio. I think from the bank's perspective, I think the audience would actually be quite good to eliminate on that. But I think, again, a lot of my counterparts at the institutions, that they tell me that, it sits between systems and institutional as well, is that, like, for instance, for a lot of the American banks that are in the UK or vice versa, they're usually reporting to like 2 regulators at the same time on the same positions, because obviously to your local office you have to report to your local regulator what you're holding, to your global headquarters you need to report to that regulator as well, and a lot of the times the regulators are assessing risk on very different levels. So some assess risk based on ratings, the others assess risk based on the seniority. So it's actually different regulatory environments that need to be approached with. So I think that's also having a sort of like creating a conversation about how how systems actually need to be managed in this environment as well. So I think from the buy side, we're pretty much building our own systems as we speak. We're not really under any regulatory onus just yet. Soon it might come, but on the banking side, I guess we need to.
have an easy question. Who pays for those improvements? The investors or the firm using the system improvement?
I mean, usually expenses are allocated within the fee structure itself. You know, you can't. I mean, just as an example, you can't go to investors by upgrading our systems. Here you go, above your management fee or performance fee. We're billing you for that. Obviously, it has to be. You want to provide a service where you're comfortable with your portfolio risk at the end of the day, right? It's your reputation. It's, you need to understand about where the market is going. And I think what's good, I mean, even though the credit markets have returned, in my opinion, when you do have difficult cycles, it really wakes you up in a way to make sure that you are insulated and you understand your risks. Because, as the first thing you're taught on the training course, you don't think about your return, you understand your risk. And I do feel that if we've had one takeaway lesson from the credit crunches, understand your risk metrics better than you understand what your return profile is, because that's going to come and haunt you. So yeah, just to answer your question, we wouldn't bill that to the investors. We'd like to, but we wouldn't.
Yeah, it's the same. I mean, it's to some instances like a chicken and egg. I mean, in order to attract more institutional clients, you need to have better reporting systems. So you have to have that in place before you go in. And sometimes there is a requirement, specific requirement from an investor who requires a certain new reporting tool or something that they're comfortable with. So, but it's mainly charged for the fund, but it's not so much as you want to charge the investors. More like just what we're seeing is that the better risk reporting that you can provide, the more flexible it is, the more acceptable your product will be to the institutional investor space.
So we've almost come to the end of our time, but the last thing that I want to touch on, which is also related to systems, is actually risk reporting. So going back only a short period of time, seeing risk management had a significant population, although they're called risk management, there was a significant population who are actually just doing risk reporting. And I'm just wondering, given the discussion on systems, if that is changing to free up risk management to do more of that proactive risk management than pulling together yesterday's results.